SoFi technology stock has been trending in popularity recently, and many people are wondering if they should buy more, sell what they have, or stand on the side for a better timing. As the market is still very volatile for the moment, we should be careful about which stocks to pick, as well as what would be the exposure and timing of those positions. Over the past few days, the price action of SoFi has brought the stock to around $5.25 before stabilizing around the current $7.50 or so. SoFi had a decent run recently, recovering some of its losses during the massive sell-off that occurred during early May. With that being said, there's still a lot of losses to recover, so we have yet to see whether the steam will run out before it reaches back to $10, its initial price at IPO. The reason for the sell-off are quite simple and do make sense. A business model put under pressure as the moratorium of students' loan is extended, and the general skepticism and capital flight away from the growth stocks since 2021. It's safe to assume that the market is reconsidering its goals, and so far, the participants believe that they have been overly exposed to market volatility. The interest rate increases by the central banks are also putting additional pressure on the whole situation. Now, with that being said, the main question to ask now is whether you should be buying more stocks or to benefit from the next bull run. In this regard, I would recommend additional patience and prudence. Recent recovery is certainly encouraging, but it's nowhere near a full recovery. And we're not sure yet if this recovery so far is just a brief episode pausing from the massive losses and sell-off that happened this year. Now, let's also take a look at the technicals of the stock. The trading volume of SoFi has recently been around 36 million shares versus the average volume of 56 million shares. Over the previous 52-week period, its price fluctuated between $4.84 and $24.95. The market cap of SoFi Technologies is currently around $6.2 billion versus the enterprise value of $13 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note about the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company can generate more profit or just do better than competition because it has a better management team, a stronger brand recognition, and a bigger online following. It is essentially what makes your company unique compared to alternatives. In other words, it's not a tangible asset that companies can use. It is, however, the reason why some companies are perceived to be trading at a discount, as the market cap is lower than the enterprise value, because the enterprise value is less reactive to the market cap in volatile situations. If the company goes to liquidation, the goodwill would be gone, and we're going to be left sharing whatever that's left on the balance sheet column. When we compare the current price to the historical price fluctuations, the stock is 52% higher than the 1-month low, 52% higher than the 12-week low, and 52% higher than its 52-week low. On the options market, which gives us a hint about the market sentiment on where the price is likely going to go next, the implied volatility is 90% versus a historical volatility of 94%. The put-call volume ratio is currently 3. It's normal for many stocks to tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 88,000 contracts a day, compared to the 30-day average volume of 94,000. In terms of open interest, the most recent volume of open interest has been 1.8 million contracts versus the 30-day average of 2 million contracts. In terms of the shareholder structure, institutional shareholders own about 46% of the outstanding shares. The biggest shareholders include Vanguard, SoftBank, and BlackRock. It's relevant to understand the shareholder composition of a company because this helps to determine whether you should hold a stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions since there are many great companies mostly held by retail as well, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, it can be a sign that there's an organized shorting operation going on, like what happened with GameStop and AMC. The current short interest is 20% of the total float, and 54% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant chunk of those coming out of the dark pools, this can suggest that there are potentials for a short squeeze. My recommendation is to first make sure that you have a position in Sofi and to wait for the market momentum to start building for the entire sector to start buying Sofi in bundles. Until then, I would recommend the dollar average up to 40% of your allocated amount in the stock when the retracements occur. The rest of the allocation should be used once the market tendencies have changed from what they are now. I would therefore recommend to commit between 1 to 3% of your portfolio in Sofi. I would also recommend to split the allocation in batches of 20% at a time so that you can purchase more if it retraces further. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.